Welcome to Kitco News. I'm Niels Christensen, and I'm here with Mike Philbrick, President of Resolve Asset Management.
Yeah, thank you, Niels.
Thank you for joining us today.
Pleasure.
Let's jump right in.
Sure.
What is your take on market sentiment right now? I mean, are you guys more defensive? Are you guys, we were talking off camera, you're heavily into treasuries. Yep. Is there anything that concerns you in the market?
Yeah, of course. I think there's lots to be concerned about in the market, but I think that is not too dissimilar to any market. One should always be monitoring what's going on, understanding how the implications for Fed policy can affect price changes. There are structural linkages between things like Fed announcements and asset prices. Right, and so bonds is a classic example. What's happening with quantitative tightening or easing? What's happening with decisions on rates? And I think we've been in this really tumultuous period of adjustments in Fed policy over the last sort of, call it 9 months, which have manifested in some pretty interesting asset price change dynamics. And so I think there is lots to be thinking about. I think investors should do their best to think about a reference portfolio, if you will. What would I own if I knew nothing? If Niels, you and I were saying, like, there is nothing to bet on right now, right? There's just nothing, there's nothing interesting happening in the world. That's a portfolio. And that would be a reference portfolio.
That sounds fantastic.
It would be, but let's pretend for a second. But then that allows us to do the thought experiment of what would a perfectly passive expression of our beliefs be. It might not be, we can talk about what true passive is versus what an expression of your passive would be and different types of passive type portfolios. But first we should come to that, so that then we can take bets against it. We can figure out how we might influence that portfolio with various beliefs. So at Resolve, we're systematic in our approach. So we use algorithms. We're global in our approach. We're global macro investors, systematic approach. We express that via ETFs or futures, depending on the type of mandate. And so I think that's a key, right? What's your non-impact what's your basic neutral portfolio, and then how might you inform that? And as you mentioned, we've had very, very heavy positioning in both 7 to 10 year treasuries and 20-year.
Would you say you're more defensive, less defensive?
Yeah, the risk in the portfolio is predominantly bond-based at the moment in our more adaptive portfolios. So I should add, risk parity is a type of portfolio construction that we will use, and in that you're really seeking balance, but you're seeking balance across all of the dynamics that come into play with inflation and growth.
Is inflation? So where do you see gold then? I mean, if you're defensive, do you like gold in this environment?
So at the moment, I will say in our more adaptive portfolios, we don't have any exposure to gold. Having said that will change daily. So I don't want viewers to take that as a position where in a week, it's quite possible that we would have positions in gold. And in fact, in April, we had positions in gold. And so we're looking at the markets on a daily basis. We're understanding the trends in the markets, momentum that's there. We're adjusting that for things like carry. We're also optimizing the construction of the portfolio. So it's possible that gold would be in a very good trend, but may not be included in the portfolio because it didn't add any diversification benefits. At the same time, I can say that we've had gold in the portfolio previously where it didn't have a particularly strong trend, but the asset was so orthogonal, so unique to the portfolio that adding it increased the Sharpe ratio of the portfolio. So that's kind of the space we live in with respect to whether you include gold or not. I would say absolutely people should be considering gold as a position in their portfolio in some way. Whether that's that strategic allocation, remember we've got the no bet portfolio, we don't know, and we would own some gold. And then how might we impact that position based on some systematic measures, some predictive measures like momentum, like carry, like trend, to maybe expand or contract that allocation. So just in our risk parity portfolios, we do own gold. And we will own that position in a pretty static, it vacillates a little bit, but a pretty static ownership.
Do you like gold? Do you like miners? I mean, what's your take on the mining sector? I mean, and to follow that up, what sector do you like?
Right. So on the sector side, in some of the portfolios, there are constraints in Canada on how much gold you might be able to own as an asset class. So in those cases, we will dabble into the minors to round out the exposure if in fact the exposure is supposed to be higher. Now that's a workaround. That is something that you have to figure out to get the exposure you want in the structure, and the structure might have limitations. But the reason that you always want to be considering gold is because of the structural relationship it has with the inflation dynamic. And I think you and I talked a little bit off camera, but in the 1970s is a classic example. So the 1970s, the common 60-40 portfolio actually had negative real rates of return for a decade. And in that decade also had a couple of drawdowns that were sort of 30% plus. And I can tell you, at the end of the 70s, you go into 82 and that peak in gold happened. There was a lot of excitement and exuberance around gold, and at the wrong time. Probably 2011 was kind of a similar experience. So, but in the 70s, whilst your 60-40 portfolio was having a negative real rate of return, gold compounded at 24% real. Because it was an inflationary dynamic. So would you want to be considering gold in that period? Could it have helped your 60-40 portfolio actually give you a reasonable rate of return? The answer is a resounding yes. So where do we sit today? So it's not, Wayne Gretzky, not where the puck was, where's the puck going to be? And when you think about that 60-40 portfolio today, stocks, bonds has done so well. So we've got a recency bias of its performance being so well, and I think we've got a bit of an overconfidence bias where people are not considering alternative assets like gold, like real estate, that can really add true diversification to their portfolio.
Is gold just an inflation play? I mean, what are your thoughts on its safe haven aspect? If we are entering an economic slowdown, if equities are sort of topping out and frothy and stuff like that. For you, what does gold look better, as an inflation play or safe haven, or is it both?
It's both. It actually, so if you think about that inflation and growth dynamic I talked about, it creates four regimes. And in those four regimes, on the right side, and we've got a lot of this on our website, we call it the market target, but you can go look at it at investresolve.com. But you can see these four regimes, and where gold plays is in that inflationary stagflation type event in the 70s, and in the deflationary events like 2008 and like 1929, where it's about return of your capital, not return on your capital. And gold is that, it becomes that safe haven asset. I don't know why that humans have decided that behaviorally this is the thing that that's beyond.
You argue 5,000 years of you can't.
So it's beyond my pay grade. I just look at it as it is a very different asset class that responds differently to these two economic regimes that don't manifest very often. But when they do manifest, boy, you better have some of these assets in there, like long duration treasuries and like gold, because they're the only thing that structurally will perform. The relationship there is a structural one. It can be counted on in these times of duress.
So last question then, are we entering that environment? I guess that's $1 million question.
Sure, and I'll give you two answers. On the one hand, right? So on the one hand, again, we come back to the reference portfolio. For us, that would be risk parity. It would say take those four regimes and make sure you balance the risk coming from all four of those regimes. So if we get into a deflationary spiral like we did in 08, well, our risk parity portfolios, this is testing, not live. So we have a risk parity index that we've partnered with S&P Dow Jones on. That index had basically flat returns in 2008 because you had assets like long duration treasuries and gold that were killing it, and you had stocks that were killing you. And in risk parity, this is the way it is. There's always going to be something killing it and always something killing you. But if you're missing this piece of gold because you're overconfident, you've got everything in stocks and bonds, if we get into an 08, you really have a difficult time. So I would say, from that perspective, I think, in the reference portfolio, there's a position in gold, and then you don't have to guess, right? You don't have to project or predict. Now, let's think about layering on top some alpha strategies or some predictive measures that might give you an indication how gold is doing for your portfolio. So I would probably guess that many trend followers are having positions in gold because there's been a pretty good trend in the gold price. For us, it hasn't manifested yet in portfolios. That can be for a couple of reasons. One, there's the trend, but the trend is compared to all the other trends. And then next is, does it diversify the portfolio? Is it a truly orthogonal investment at this time? And so we're doing that daily. We look at that. We're reviewing the algorithms, and they're saying, yes, it is, or no, it isn't. In April, it was in and had a growing position. It subsided. I would suggest that if the current trend continues, then we'll see gold creep back into the lexicon.
So I was going to say, like the rally has been fairly quick, so you'd want to see something more sustainable.
Yeah, it's for us. We're a little bit like we're looking at trends all the way from the 15-day range to the 300-day range. But you don't want to be too quick, but you also understand that if there's a price you pay for waiting.
Yeah.
And so, I think we always consider it as an asset class. We think it is truly orthogonal. It marches to a different drummer. That's what you want. So in your passive portfolios, there's a place. In more active portfolios where you're willing to vary the weights, you've got to have a system and a process to do that. And don't leave it to your gut. Like your gut and your emotion, they're not reliable. That's why we've gone more of an algorithmic way, right? Where we're using factors, investment factors, and in unique and novel ways to separate the signal from the noise in order to suss out, is that trend really that strong? How strong is that trend? How does it play into the rest of the portfolio?
That's perfect, Mike. Thank you very much.
It's a pleasure. Thanks for having me on.
That was a fascinating conversation. I really enjoyed that. Thank you very much for joining us.
Yeah, pleasure.